welcome to CFA Level 1, and this time it's going to be monetary and fiscal policy. All the more, I wouldn't say would be too challenging, a lot of theoretical stuff, not too many diagrams compared to that of demand structures or something which you've seen in the previous chapters as well. But all the more when we know in general, we talk about monetary supply, really trying to be able to modify the money supply, how much money should actually rotate around in the system. While you're looking at fiscal policies, is going to involve how much government is going to spend in terms of expenditure, infrastructure, stuff like that, and also on the tax system as well. Of course, they're going to modify the tax, the amounts really, you can say, to increase or decrease taxes depending on if they want to increase or decrease the spending power of the people, of course, to control inflation or also to control recessions, either way as well. All the more these policies, or rather these concepts, will be carried forward in level 2 and in level 3. Now let's focus ourselves on monetary supply, and really the whole point of this policies or whatever the governments are really able to enact is to be able to make sure that able to create management of supply and credit. Supply and credit of what? Money, really, to be able to just understand and see how the system works. We are talking about an expansionary policy where they're going to actually increase the money supply, which is going to be because of decreasing the interest rates and increasing demand. And it makes sense over here. If there's not going to be high interest rates out there, let's assume that the short-term interest rates are going to be low. The opportunity cost to be able to actually go and invest at a certain rate of interest is also going to be low. There's going to be a lot more money in the hands of people as a result, because of which they'll increase their spending power, their purchasing power, or in other sense as well, albeit it'll end up increasing the demand. Contractionary, on the other hand, is going to be the opposite, where they're actually going to decrease the money supply instead. Now, if just let's assume that the short-term interest rates are going up and they're at quite a high level, it's going to be a high opportunity cost. Now, if it's going to be 7% over the next 2 years, for example, that's a considerable amount of interest. Now, I could use that money right now and feed my short-term consumption, short-term needs, if you will. Or I can just postpone the spending and then increase my purchasing power in the future. Yep, albeit I get 7% a year. So that 107, it becomes 107. Compounding that becomes almost $114, a little more than 114. So more the interest rates in the system, more the opportunity cost, more induced to actually go in and invest. The more the investment is done, the less ends up remaining in the hands of people. Less is going to be in the hands of people, less is going to be the demand for those goods and services out there in the market. And of course, we can say that as demand keeps on decreasing, it can lead to, well, reduced supply over time. It can also create slow economic growth, and too much of interest rates can also end up actually really fueling inflation as well. Talking about fiscal policy, now here it's going to be involving two components, and we're going to talk about in terms of taxing and in terms of spending. By tax, income taxes, direct taxes, indirect taxes, sales tax, value added tax, the whole shebang really. And in terms of spending, you're talking about spending in terms of government expenses, subsidies, in terms of infrastructure spending. That's all considered to be a part of fiscal policy. If the government is going to create an expansionary fiscal policy where they're actually going to end up increasing spending and or decrease taxes. So it's going to be increasing spending, or they're going to decrease taxes, or it could be a combination of both. And obviously this is going to end up increasing the budget deficit. Now budget deficit is going to be, well, you have government expenses which is going to will reduce by the government income. So it's G minus T. Expenditure minus the taxes. The taxes is the revenue for the government. Obviously, the more is being spent compared to the revenue earned, there's going to be a deficit. But on the other hand, this is actually creating an increased aggregate demand because, well, of course, government is spending. So there's going to be, of course, the government's excess demand being incorporated into the market. Contractionary, my apologies, is also where they're really the opposite. Decreasing spending and or increasing taxes. So they can decrease spending, they can increase taxes, or have a combination of both. Albeit in the opposite case, they'll create a decrease in the budget deficit where the revenues are going to be more than the expenses. It could create a budget surplus, also known as a fiscal surplus. In the end, this will definitely reduce the aggregate demand as well. Now, when you're talking about these two terms, we have increasing aggregate demand here and we got decreased aggregate demand. Now this is going to increase and decrease the demand for not just the government but also for the public as well. Thinking about it through now, of course, if there's going to be increased spending in terms of expansionary, the government is going to increase spending, be it albeit on goods and services or be it on infrastructure, so on and so forth. So the demand is going to be for the government perspective is going to increase. On the other hand, they also say that they have decreased taxes, meaning people will be ending up having a lot more money left out in their hands net of tax. Albeit for people as well, they are really, you can say, is that even their consumption can actually end up increasing because they have actually got a lot more money left out in their hands. Contractionary, on the other hand, the case seems to be the opposite. There's not going to be as much expenditure done, so of course demand from the government's perspective ends up falling. The government expenses are lesser than the revenues, or you could say revenues are more than expenses. So instead of a budget, you'll end up having which is known as, you have a fiscal. It's going to be a little difficult for me to write that here, but there we go. Fiscal. All right, fiscal deficit, and of course, this is going to reduce aggregate demand not just for the government. It's a G right there, but it's also going to be for the general public as well. People will end up having to pay a lot more taxes. People have a lot less money left out in their hands net of tax. As a result of which they'll end up spending a lot less. Now, you're talking about the functions of money. Now, obviously, it acts as a medium of exchange, and this we can really say in our day-to-day lives as well. We need to go in and buy groceries, be it just bread or milk or fruits or whatever you want it to be, or if you end up just going to a cold storage or to a supermarket as well. Anything or everything that you end up buying, and of course, and dump your products at the counter, and of course you're going to end up paying money in exchange for those goods and service, or rather the goods and also for the service, really, that they're giving you all the products under one roof. So it can be a medium of exchange. As a unit of account, definitely as well. Now today, if I'm holding a greenback, a US dollar note, it could be any, be a $1, $20, $50, $100, irrespective. Now, if I'm holding a $100 bill with me today, I know for a fact that this note is worth $100. In the current economic situation or in the current economy, I can buy stuff which is going to be worth $100. So it's going to be a unit of account. And of course, it's going to be of store of value. It's the exact same thing. This $100 are actually going to hold some kind of value in the end. I can actually go and store this $100 in the end. And let's say just let me keep it there for like a year. Once I bring it back out of the vault after 1 year, well, in today's case is, well, vault less, ATM more. But the value of that same note is going to be $100. Although the real value of that $100 is going to be less in the future, well, because of inflationary concerns, but it's going to have an actual store of value. The $100 today is not, in terms of really nominal stuff, or rather just in terms of an absolute, the $100 remains. But in terms of real value, obviously the value actually declines. And of course, it's going to be a much more efficient system than a barter economy. But I mean, of course, when you talk about in terms of barter, you're trying to be able to exchange chickens for goats. I'm just giving an example, really. I've not been a part of this barter system. But I mean, just you have to imagine that it's really going to be on the basis of assumption. Now, today, if I'm going to trade chickens with somebody so I can go and buy a goat, for whatever reason, really, I'm fed up of selling eggs and now I want to sell milk instead. Now, how much is one goat's worth in chicken value, really? Is one goat worth five chickens, or is like, the equivalent weight of the goat compared to the equivalent weight of the chickens? I don't know, really. But then when you're looking at it in terms of money, it's going to be able to create an economic system where you have certain value which has been added across time.